Hey guys, what's going on? Welcome back to Stocks with Surfing. So today I'm doubling down on a company I already believe is a global compounding machine. If you've been watching the markets lately, you'll know that Mastercard has been under some serious pressure, but everything has changed this morning. Mastercard has just released their Q4 earnings report, and they didn't just beat expectations, they absolutely crushed them. We're talking about an adjusted earnings per share of $4.76 against a $4.21 is what the analysts were looking for. Revenue is up 18% to over $8.8 billion, and the secret sauce, their value-added services, is accelerating at a massive 26% clip. So over the past month, Mastercard has suffered a 7% sell-off as the market panics about President Trump's proposed 10% interest rate cap. I'm seeing a rare opportunity here to buy one of the world's most profitable toll booth businesses at a 10% discount. Mastercard isn't just a credit card company, it is the invisible plumbing of the global commerce. They've evolved into a high-margin data and AI powerhouse that connects billions of people, and today I'm putting my money where my mouth is and making this the largest position in my public portfolio. To understand why I'm buying, you have to understand what Mastercard actually is. Most people think they are a bank. They see the word credit card and assume Mastercard is the one lending the money and charging the interest. That is 100% incorrect. Mastercard is a payment network. They are the plumbing. They don't lend money. They provide the rails that connect your bank to the merchant. When you swipe your card, Mastercard takes a tiny fee, a few cents, just for authorizing the transaction and making sure it's secure. Whether your bank charges you 30% interest or 10% interest, Mastercard still gets their fee on the swipe. They are a royalty on global consumption. As long as people are buying groceries, gas, and plane tickets, Mastercard is going to continue to get paid. Now, you might ask, why does adding more cards matter if the fees are so small? This is where the flywheel comes in. In 2026, Mastercard's growth isn't just about the number of swipes. It's about the value-added services. This segment now makes up nearly 40% of Mastercard's total revenue, and it's growing at over 20%, twice as fast as its core payment business. And even just this past quarter, it came in growing at 26% year over year. So every time a new card is issued, Mastercard gets more data. They use that data to sell high-margin software to banks and merchants. Those softwares are first, cybersecurity. They use AI to detect fraud in real time. Banks pay a premium for this because it saves them billions. 2, data analytics. They tell retailers exactly how and where people are spending money. And 3, the AI pivot. Just this week, they launched the Mastercard Agent Suite. This allows banks to build AI agents that lives inside your banking app to help you shop and manage your money. By adding more cards, Mastercard isn't just getting more swipes, they are feeding a massive high-margin data machine that is becoming impossible for banks to leave. They are moving from a payment company to a data utility. All right, so now let's take a look at Mastercard's revenue growth by business segment. So let's start with value-added services. This is the fastest growing part of Mastercard, and by 2027, it's projected to be the company's biggest revenue driver. It's a high-margin software business where Mastercard sells cybersecurity, data analytics, and loyalty programs to banks. The big news for 2026 is the Mastercard Agent Suite, which lets banks build their own AI agents using Mastercard's data. This isn't just about payments anymore, it's about Mastercard becoming the essential AI infrastructure for the entire financial world. Number 2, we have cross-border volume. So if you want to know where the real profit is, look at cross-border. These are fees Mastercard collects when you use your card in a different country than where it was issued. These transactions are 6 to 10 times more profitable than a local swipe. As global travel and e-commerce continue to explode through 2027, this segment acts as a massive cash cow. Best of all, it's completely international, meaning it's 100% shielded from any US interest rate caps or regulations. Number 3, the payment network. This is like the core growth engine of Mastercard. This is the steady Eddie foundation of the company. It's the basic fee Mastercard charges just for being on the network that routes money between your bank and the merchant. Think of it as the toll booth for the global economy. It grows consistently alongside global GDP and the ongoing shift from cash to digital. It's the most boring part of the business, but it provides the most stable floor that allows Mastercard to invest so heavily in high growth AI and tech. Now, domestic quick US assessment. This is the segment the media is obsessed with right now. These are the fees from US card holders spending at US merchants. While the headlines make it sound like the whole company is at risk, this is actually the slowest growing part of Mastercard, and by 2027, it will be the smallest of these four segments. The market is pricing the stock like it's 100% US dependent company, but the reality is that the US front porch is just a small piece of the massive global fortress that is Mastercard. And if there's 10% interest rates caps in the US, that's not going to happen around the world. All right, now let's take a second just to look at the earnings that Mastercard released this morning. As you can see in the background here, as I talk, we got the stock chart, and Mastercard's actually up 3.25%, which is a nice change from normal, man. It feels like this thing has just been going down every day for most of 2026 so far. So let's take a look at the results. As you can see, for adjusted earnings per share, they reported 4.76, so $4.76, beating what the analysts expected of $4.24. Very good. Total revenue, they beat, reporting $8.81 billion, and the analysts expected 8.78 estimate. For value-added services, they reported $3.89 billion, which is accelerating extremely quickly at 26% from last year. Now, cross-border services is up 14%, which is stable. It's growing at a good pace, but nothing too insane. And for gross dollar volume, that they reported 2.82 trillion, and it's only up 7%, which is the slowest part of the business. Now, as I've said before, the gross dollar volume there for the US, that is actually the part that would get the interest rate cap if President Trump were to go through and find a way to somehow do that, although it would be fought on every level. So that being said, let's take a look at the new bear case for Mastercard. So we'll get to the new bear case in 1 second. Before we do that, I just want to touch on the fundamentals of Mastercard to show that this is an extremely strong business. So let's start with the gross margins. As you can see, Mastercard is extremely efficient. Their 77.9% gross margins are staggering. This is the hallmark of a world-class software business because it doesn't cost Mastercard much to process an extra million transactions on their existing rails. Nearly every new dollar of revenue drops straight to the bottom line. This gives them a massive cushion that most companies can really only dream of. Next, we got free cash flow, the shareholder fuel. Free cash flow is the real money left over after all bills and investments are paid. Today's report shows they generated over $16 billion in cash last year. This is the fuel for that massive $14 billion share buyback program. When a company has this much cash, they don't need to worry about high interest rates. They use them to their advantage. And then I wanted some sort of debt ratio on here, so I decided to go with interest rate coverage ratio. This is the safety net. If you look at their debt, don't get scared by the total number. Look at the interest coverage ratio, which is 45 times. To put that in perspective, a ratio of 3 times is considered safe. Mastercard is 15 times safer than the average healthy company. They earn 45 times more than they owe in interest payments. This is a fortress of a balance sheet, plain and simple. Next, we're going to look at the forward PE ratio just to show you guys how it is kind of trading at a discount to where it's historically been at. Finally, looking at forward PE ratio of 27.2x, historically, Mastercard trades closer to 34 times. Because of this recent dip, you are getting a 15% growth company at a 20% discount to its historical fair value. The market is giving us a gap between the price and the actual earnings, and a rational investor, that's exactly where we want to buy, and that is one reason why I doubled down today. Now let's take a look at the new bear case. Now, this entire bear case has to do for if the 10% interest rate cap actually goes into place in the United States. So if a 10% interest cap goes into effect, banks might decide that subprime or low credit borrowers are too risky to lend to at such a low rate. They could cancel millions of cards, creating what economists call a credit desert. If those cards aren't in people's wallets, they aren't being swiped. That would directly hit Mastercard's US transaction volumes. And obviously, if the cards stop getting swiped, they don't get the data and they don't get the money. So that would also, in return, would kind of hurt the value-added services. Now, this is the new bear case that is sort of being formed with this 10% credit cap potentially that could happen, but I don't think it's going to be that big of a deal, because even if credit cards get banned, people are not going to stop buying things like food. They're going to switch to their debit cards, and well, Mastercard also owns the rails for debit cards as well. The fees are slightly lower, but they're not going to lose the customer entirely. And on top of that, even in the worst case US scenario where 20% of cards are canceled, that only affects a potential of the 25% of revenue that comes from the US. The other 75% of the company, international and AI services, are going to remain relatively unaffected, apart from the data that won't go to the AI services. But on the ultra rational side, we're probably not even going to see this happening. This is being talked about, but it will not happen, because realistically, no politician wants to come out and take credit cards from people, just because it would be so unpopular to their approval rating. So, it could happen. I could be surprised, but I really doubt any of this is going to come true at all. Realistically, what will probably... And well, that concludes the video on why I bought some Mastercard today and why I'm going to continue to hold this company for a long time. I think it is extremely powerful. They have an insanely deep moat, and I think they're trading at an extremely fair valuation right now. Now, none of this is financial advice. This is all for entertainment purposes, and I'll see you guys in the next video. And hey, if you enjoy it, subscribing would be awesome. All right, I'll see you guys soon. Easy.